Types of insurance. There are broadly three categories of insurance: life insurance, health insurance, and general insurance. General insurance typically covers your assets. For life insurance, there are mainly two types: the unbundled product or the bundled product, which will include your whole life insurance, your endowment products, and your investment-linked product. And for health insurance, it will include your MediShield, your other healthcare schemes such as ElderShield, DPS, and group insurance. Let's take a look at comparing the different types of life insurance. For term insurance, the main objective people purchase term insurance is mainly just for protection. For whole life and endowment plans, it provides you with protection. At the same time, there's also a potential to grow your savings. And commonly, people take up a whole life insurance or an endowment insurance to also, at the same time, other than meeting the protection needs, to also meet other financial needs like education goals and retirement needs. For investment-linked product, it is very similar to whole life and endowment. It provides a protection as well as the potential to grow your savings. Again, people could use it to meet their other financial goals like retirement and education. In terms of scope of coverage, all the plans will cover death. Most plans will cover permanent disability, and some plans may also cover critical illnesses. This will vary according to the different insurer as well as the different products. In terms of cost, term insurance will be the most affordable since they only provide you with the coverage. If the covered event does not occur during the covered period, there will not be any cash value. Whereas for whole life, participative, and endowment plans as well as investment-linked product, they tend to be more expensive given the same level of coverage. As other than protection, they also offer an element of savings. In terms of cash values, as mentioned, term insurance do not offer any cash value. For whole life and endowment plans, the cash value will comprise of the guaranteed value as well as a non-guaranteed bonuses. So whatever values you see as non-guaranteed at the point of purchasing the insurance is only a projected amount. This value can be lower as the years, it all really depends on the performance of the participating fund. Well, investment-linked product, then the entire cash value is non-guaranteed. The sub-fund values will depend on the investment performance of the underlying sub-funds. In terms of characteristics, for term insurance, there are mainly two types: a level term insurance or the decreasing term insurance. For level term insurance, your sum assured simply remains the same throughout the covered period. For decreasing term, your sum assured will decrease over the years up to zero value by the time it expires. It can also offer two other features such as convertibility as well as renewability. Renewability simply means that you can actually renew your term insurance when it expires under the same health condition at the time when you took up the plan. However, the premium could be higher depending on the age at the point in time. And in terms of convertibility, you can actually convert your term policy into either a whole life policy, an endowment plan, or an investment-linked plan. Again, there will not be any health underwriting. However, the premium could also be higher because of your age. For whole life and participative endowment policies, most insurers allow you to put in riders to actually enhance the benefits, such as protecting you on critical illnesses or hospital income. And because the policy provides cash value, you can also take a loan against your cash value. However, the insurer will typically charge you an interest on this borrowed amount of between 5 to 8%. And if you do not pay up this loan, this unpaid loan amount will be deducted from your cash value or when there's a claim payout. For investment-linked products, most of them, they offer more flexible features such as partial withdrawal, meaning that you can actually withdraw some of the cash value when you need it. So it is not considered a loan, but it's a withdrawal. At the same time, you can also take a premium holiday. That is, you can temporarily stop paying the premium should there be an emergency cash flow problem. And you can also perform ad hoc top-ups by simply investing more money into your investment link plan. You are also allowed to switch funds and choose a different sub-fund if you anytime you want to. Your sum assured can also be adjusted either upwards or downwards. But if you are adjusting your sum assured to a higher level, then of course there will be health underwriting. In terms of premium and charges, for term policy, it's usually level throughout the period unless you renew it or if you convert it. So when you renew or convert, then the premium will be set at the age where to convert the policy, and at the same time it will also be the premium level of the product that you actually choose to switch to or that you choose to convert to. For whole life plans and endowment plans, premium is also fixed throughout the policy term. As mentioned, there can also be riders that attach to these two policies, to this type of products. However, some of the riders may also, the premium could increase with age. For investment linked plans, you may be allowed to adjust your premium. However, it is subjected to a minimum amount set by the insurer. There will be other charges as well for investment-linked products, such as management fees. Mortality charges may also apply, and they may increase with age as well. Charges can be paid by deducting the units from your portfolio. In terms of investment risk, there's no investment risk in term because there's no cash value. For whole life and endowment plan, the investment risk will be the non-guaranteed portion, which will be borne by the policyholder. And for investment-linked product, the risk is 100% borne by the policyholder. In terms of the premium payable, for term policy, it's normally payable throughout the period of coverage. For whole life and endowment plans, it can either pay throughout the period of policy or a limited period. It varies depending on the product as well as the insurer. And for investment-linked product, your premium could be on a regular basis or as a lump sum single premium. Annuities, which is also a type of insurance policy which guarantees a fixed payment at regular interval, usually monthly, for as long as the policyholder lives for a fixed period. Annuities are mainly used to provide for retirement income. A premium is usually payable either as a lump sum or in regular payments for an agreed time period. A typical example of annuity would be your CPF Life.